Welcome to the Trading Bell Show. We are talking matters Finance Bill 2024. Of course, there are so many sentiments out there about what it is having in store for you, Kenyans, and even the businesses. But just to dissect that, I've been joined by a panel of eminent persons, if I may call them that. That is Chachi Logudu, economist at IC Group. We also have Beatrice Ndungu, tax manager at KPMG, and Fred Kimodo, senior tax Deloitte East Africa. We want to dive into that conversation right now, and of course, get to see what is it for you and what do we need to also give as proposals that we have been invited to give. Ladies and gentlemen, welcome to the show.
Thank you.
It's great to have you, and I want to start this conversation by looking at the positive side of things. What are your one or two quick picks that you can say are wins for Kenyans, businesses, or even individuals at large? And I want to start with you, Fred, if you could open that session.
Thank you very much, MC, for having us.
Yeah.
So unlike last year, under the Finance Act of 2023, this Finance Bill of 2024, we have seen quite a number of positive things for the employees.
Yeah.
Where we have now, for example, the allowable deductions, like things like the housing levy, they're now going to be taken as a deduction before you arrive at your tax liability.
Okay.
And besides that, there has been a conversation in terms of increasing some of the exemptions, thresholds that we do have under the Income Tax Act.
Yeah.
Key among them, something like the pension, which is currently at 20,000 Kenya shillings per month. Mm-hmm. There's a proposal then to increase that one to 30,000 Kenya shillings per month, and quite a number of other thresholds that have been proposed to increase.
Okay.
So the only thing that we probably have seen from a consumption taxes perspective, it is moving in the opposite direction.
Okay.
There's quite a bit of burden that is likely to be imposed on taxpayers from an indirect taxes or consumption taxes perspective.
Okay.
And I'm sure we could dive deeper into them as we go.
Absolutely. Thanks for that peek. Let me come to you, Beatrice, as well. Any quick positives that you have seen in this?
Okay. Thank you for having us.
Yeah.
I must say, as Fred has said, employees have got to be the biggest gainers in this finance bill. There are so many proposals that will increase their disposable income, and one of the things that really stands out is the pension treatment, that now you can withdraw pension after 20 years of being in a fund without paying taxes on it. That basically means if you started working at 25 and you're around 45 thereabout, you could probably withdraw now. Once it's enacted, you could withdraw your pension without paying tax.
So with the current law, you would be taxed if you withdrew?
You would be taxed.
Okay.
If you withdrew before retirement age, and actually even at retirement age, you would get, you'll be taxed at a lower rate.
Okay.
And the only people who wouldn't pay tax are who are above 65 years.
Okay.
So that is definitely a very good move for consumers. But then on the other hand, consumption taxes have gone up.
Okay.
So whatever is saved on this side is taken up on the other side.
Okay, we'll be diving into that. Chachi, let me also give you that opportunity. What wins have you seen?
Yeah, thanks, Maina, for having me.
Yes.
I agree with my panelists. The biggest winner in the Finance Bill 2024 definitely is with the employee.
Yeah.
I've seen a bit of some concessions, positive concessions being made within the Finance Bill context. So just to make it short, I think those are the biggest winners that we are seeing in the Finance Bill 2024.
Okay. Let me come to you again, Chachil. And, you sit in a place where you're talking macros and looking at the economic, state of the country and even Africa around. And I wanted to ask you, do you think the approach of raising these particular taxes on existing taxpayers and businesses is sustainable for long-term economic growth?
Well, let's put it this way, because we're looking at the Finance Bill 2024, but within the context of a budget whereby money needs to be raised to fund the budget for the next financial year. So from that context, from that perspective, we are at an area whereby the current expected tax revenue for the ordinary revenue for this financial year that is coming to an end is 2.5 trillion, and then the next one is 2.9 trillion. So there's 400 billion that has to be collected, and hence the finance bill is coming into play. But then again, to your question around this certain pool of taxpayers that are already there, and we keep on increasing the tax burden upon them. Obviously, that doesn't make sense, and it might even be counterproductive in the long run because you're just trying to milk from the same cow, but there's a limit to it. And coming from the perspective, if you look at it broadly, we're looking at income taxes, which are now what you call the direct taxes.
Yeah.
And the numbers that you saw even from the economic survey that came out 2 days ago, in terms of the people who are in formal employment is around 3 million. So that's around 15%, 16% of all the people in employment, formal and informal, 15.6% are in the formal employment category. So from that pool, it's still small vis-a-vis what is out there. And indirect taxes now encompasses everyone. So in terms of income taxes, obviously there's a bit of some relief for the employees. But then again, these are the same people whom the consumption taxes, indirect taxes, be it excess duty, VAT, are now being increased in the context of finance bill. So I think it's quite counterproductive now to increase more taxes upon them.
Okay, thank you so much for that. And Beatrice, let me come to you. One of the key things I wanted to ask you is on whether you see any merits in reviewing some of the provisions that were introduced back in the Finance Act 2023. What did you have to say about that?
I think one of the interesting things to see, there are some things that were introduced in Finance Act 2023 that are then coming and being reversed in the bill, and one would really wonder why the government is doing that. And one of the significant is the proposed increase of the excess duty on mobile transfer from 15 to 20%, and the same on bank transfers. It's interesting to see this being taken back where they were merely 1 year down the line, and that makes one wonder maybe what is proposed this year. Is it possible still next year is reversed? There is also a lot of movement within the VAT Act with the exemption. Some things were exempted last year. Right now they are being proposed to move back to zero rated, and I would say that constant change of taxes, there is a lot of uncertainty even for investors coming into the country. They really don't know what will stick, and that in itself could be problematic.
Okay. Kimodo, let me come to you. And one of the key things I wanted to is to zoom in into the specific amendments and their implications. I wanted to ask you, from your perspective, what specific changes to the income tax that Churchill has mentioned about are most concerning, and how might they affect individuals and corporate taxpayers?
Thanks, MC. But before I come to that, if you allow me, I could just give very high level comments on the Finance Act of 2023. I think it is said that it was one of the acts that brought a lot of conversations even to the public in terms of public participation. So we saw quite a number of provisions in there. If you ask me, there are some provisions that we still need to think about, even as we look at the Finance Bill of 2024. And top among them are things like, you may be aware that the government abolished waiver of penalties and interest. We now do not have such a provision. But I believe there are some genuine cases that would require businesses to apply for waiver of penalties and interest. And we could go ahead and mention them. But what stands out for me is the introduction of e-teams, which has been discussed quite a bit, even in the media. It's a good move to have e-teams. We must say that, because we request the government every time to try and expand the tax net. So we have to give it to them that they're actually trying to do that by just ensuring that they have a view of what someone, for example, deep in some village in central Kenya or whichever part of the country, they're able to have that particular view. But what I think we should review is a provision that was actually put under the Income Tax Act, which is related to e-teams, where with effect from 1st of January, of 2024, you are not allowed to take a deduction of expenses that are not generated through e-teams. If you remember the implementation window, I think it was actually 3 months. That is, people are supposed to onboard and have their stuff on e-teams. Now, you may have noted sometimes in January, the Revenue Authority actually issued a public notice to extend that period to 31st of March of 2024. And this might have been informed by quite a number of factors. Key among them is the preparedness of the government in terms of ensuring that people are onboarded. So we are seeing a scenario where we'll have, a situation where taxpayers will be deprived of deduction of very genuine expenses just on account of things that are not within their control.
Yeah.
If today you walk to one of the counties and you're looking for a license, for example, you'll not get an ETIMS compliant invoice.
Yeah.
Does it mean that it is not a genuine business expense?
Yeah.
The answer is that it is a genuine business expense, and you should be able to take a deduction for it. So that is why, in my view, I think there is need to review that particular section under the Income Tax Act, and probably defer the punishment in terms of disallowing expenses that are not generated through ETIMS for around 2 or so years, just to allow the government to ensure that it is very well prepared, and most importantly, for taxpayers not to lose sight of the expense that they need to take a deduction for. Now, coming to your question, MC, very, very quickly, in terms of the proposals from an income tax perspective that we have seen that may require a bit of, relook, is the most popular motor vehicle tax. Maybe I can discuss it, but very briefly, because I know it has been discussed by quite a number of people. But I want to give it a bit of a different perspective. So I know we are mentioning that employees have not been hit very hard by this particular bill. But if you look at it very critically, and my fellow panelists have actually alluded to that, the employees are also being hit from consumption taxes. Motor vehicle tax being one of them. The proposal is to have 2.5% of the value of your motor vehicle. If I'm employed today, most likely I rush to buy a small car, be a Premium, a Toyota Premium or an Arion. Maybe the average cost is 2 million or the value. So that means that if the proposal passes the way it is, I'll be required to pay 2.5% of the 2 million, which is 50,000 Kenya shillings per year. So if you translate that one to per month, it will be like 4,300 shillings per month. So ask yourself, if, for example, I'm earning a salary of 200,000 Kenya shillings that have been housing levy has been imposed on me at the rate of 1.5%. How much will I be paying as housing levy? I'll be paying 3,000 Kenya shillings. So what is worse? Is it the motor vehicle circulation tax that has been introduced now, or actually the housing levy that was introduced last year? So even as we appreciate the government for giving us back a few things from an employment perspective, from an employee's perspective, I think there is need to appreciate that the same employees have actually been hit, probably even harder if you look at the whole scheme of things. Because remember also, motor vehicle circulation tax is not an allowable deduction like some of the other levies that we're actually seeing. So we need to have a very wholesome conversation on the whole bill and looking at what is the ripple effect across the economy.
I had the chairman say, don't use cars as a solution if you don't want to pay the tax. But anyway, let me come to you, Beatrice. And we have just come from the income tax perspective, and I want us to look at the VAT perspective as well. How will the changes that are proposed on the VAT impact the cost of living and consumer behavior?
I think one of the things that stands out from a VAT perspective is the introduction of VAT on some financial services, the credit card issuance, check clearance and such, and money transfer. And in a season where we are trying to increase financial services uptake, introduction of these taxes will definitely make it more expensive. And the way you look at it is, these are services that are already under excess duty. When excess duty on the financial services was introduced, the argument was they're not paying VAT. So it was put at 2015. It's now proposed to also go up in this same finance bill. So that goes to 20%. Then on top of that, you have the VAT now. And remember, VAT, you charge it on the cost, including the excess duty. So assuming the transaction cost is 100 shillings, that means there is the proposed excess duty, 20 shillings, that brings it to 120. Then you put the 16% on the 120, that brings it to 139. You see the significant increases, that it's very, very significant. So this will definitely probably make people decide, I won't transfer money. And what we probably see is, right now if you walk to any Mama Mboga, you can easily pay them through M-Pesa. They accept that. From COVID, moving forward, they have been accepting that. Before that, they would tell you, no, go withdraw, bring me the money. So we are likely to see that coming back.
Yes.
So that they're saying, no, don't give me cash money.
Cash.
When I deposit, I'm not paying anything.
Yeah.
Cash money, that's in itself is very significant.
It's actually very interesting. We talk about financial inclusion and doing as having as many people really get into the system, and then now we are sort of like sending them away. That's an opinion that I had somewhere else. Chachi, let me bring you in, and I want to bring you in the angle of the national tax policy. We keep talking about policy, and there's a lot of sentiments, especially when you listen to the manufacturers' side of things. I think the Kenya Association of Manufacturers had a statement where they're saying we need to have predictable tax policies that we are seeing. And what I wanted to bring on board is talking about increasing the tax base and everything else, and trying to also improve on compliance. Yes, eTeams is coming on board. What do you see from a policy perspective that needs to happen so that at least we are not scaring businesses away, and we still want to enlarge the tax base as well and have as many people comply?
Yeah, that's a good point. And that's actually the preamble around the national tax policy, which was even put in Parliament, passed in Parliament sometime late last year. There was a committee report that came around the national tax policy. And over and above the national tax policy, we have medium-term revenue strategy. This came in within the context of an IMF program that we will have medium-term revenue strategies covering 3 financial years. So the one that is expected to start off is the first one from the next financial year, which is pretty much coinciding with this Finance Bill 2024 up until the financial year ending fiscal June 2027, a 3-year plan. And if you look at the medium-term revenue strategy, it also had a matrix in terms of the kind of tax proposals that we're likely to see within the context of Finance Bill 2024. So if you sort of map on one hand the Finance Bill 2024 and the medium-term revenue strategy, yes, you can see that a few tax proposals have been implemented, which were in the MTRS and being implemented in the Finance Bill 2024. And then over and above those that have been implemented, we have a raft of other tax proposals that were not even, hadn't been contemplated within the MTRS being put on board. So that now brings the issue around certainty, because from an MTRS perspective, that was the document, overarching document that was supposed to bring predictability in terms of the tax policies or tax proposals over the next 3 fiscal years. And that hasn't been implemented, so we are not sure whether it will be implemented in the next Finance Bill 2025 or at all it will just gather dust in the context of MTRS. So that is the main thing that is also bringing a bit about uncertainty. We've been talking about indirect taxes having the biggest hit in the Finance Bill 2024. MTRS had actually proposed that value-added tax, the standard rate at 16%, should go lower to 15% in the context of Finance Bill 2024. So that hasn't come out. And also a bit of some measures around corporate tax, obviously to be reduced gradually, and also the pay as you earn, the top one, from 35% to 25%. If not implemented within Finance Bill 2024, probably the next iterations of the finance bills, we should see them being brought into play. But ultimately, national tax policy, medium-term revenue strategy, are the overarching documents that should bring some predictability and also attract investors in the country.
Okay, thank you so much for that. Let me come to you, Fred, and just looking at some of this introduced VAT, especially on transactions, banking transaction and all that, I wanted to narrow down to FX. Because now all of a sudden even FX transactions, that's the foreign exchange transactions, are on the radar as well. And we're talking about how the effect could be on the export, talking about foreign investments and all that. What do you see as a net effect of this if this passes?
Very good. Thanks, MC. That's a very good question. But before I come to that again,
go ahead. Please.
Allow me to comment around the national tax policy as well.
Please go ahead.
We did spend quite a bit of time, as stakeholders, just engaging the government in terms of how the national tax policy should look like. We did a bit of benchmarking. We looked at the countries in Africa that have national tax policies. Now, if you look at what we have done under this finance bill of 2024, and also look at what is happening, as my co-panelist Churchill has mentioned in terms of the medium-term revenue strategy.
Yeah.
If you genuinely ask me, I do not think that we are very committed in terms of paying fidelity to the national tax policy.
Okay.
And you could tell even the Finance Act of 2023, for example, spoke about, or rather, it did quite a number of exemptions, especially for things like special economic zones. If you read the medium-term revenue strategy, it actually talks about reducing exemptions and also reducing, or rather eliminating different tax rates. Things that were actually introduced last year. So we expect to reverse them in the course of this medium-term plan, which is 3 years. So in other words, what you're basically saying then is even from the word go, we have a policy, yes, which I agree that it was actually tabled in December last year. But our actions are not pointing towards paying fidelity to that particular document. And I'm afraid that it will continue gathering dust. If you listen to most of our readers today, I haven't heard, and I have been watching quite a number of shows, I haven't heard a single of them say that this proposal is not consistent with our national tax policy. So what does that tell you? That even at the top level, the only thing that we keep hearing is our debt is big, so we have to continue, increasing taxes or those kind of narrations. So as long as we are not committed as a country, then I do not think that the national tax policy is a conversation we should have, at least in the next 5 years. That is in my humble view. Otherwise, we'll continue having a lot of headache. Every year you'll be asking ourselves, do you think we are following the national tax policy? And maybe the answer is that we have so many other issues to deal with, and national tax policy is not just one of them. But I hope we get there over time. It's a good step that at least we have a document that is probably now ready. Maybe it's going through a bit of tweaks. I don't know, because it was not formally released to the public. Now, coming to your question on Forex and the foreign exchange transactions, I have read that particular provision under the Finance Bill of 2024, and it actually leaves a lot of questions on the table. You are saying introduction of VAT on foreign exchange transactions. Now, the way the VAT law is designed, and even when you look at the VAT that has been introduced in the other financial services, it is normally on the fee of the service that has been offered. Say, for example, you have been issued with a credit card, you have been charged 100 shillings. So they then load VAT on what you has been charged. So ask yourself, today if you had $100,000 and you walked to one of the banks and you want them to give you Kenya shillings, what do? I thought they just tell you the exchange rate today is 135 and 35 Kenya shillings against the dollar, and they count for you and give you the Kenya shillings. I do not think they actually charge any fee, but I could be wrong. Maybe our bankers could enlighten on that, enlighten us on that. So then the question that comes in is, are you proposing to charge VAT on the amount I'm exchanging? How do you know the gain that I have actually made? Sometimes I could even make a loss. So there's a lot of confusion in terms of what is this particular provision targeting. In my view, if it is passed the way it is, I would consider it to be a redundant provision. But unfortunately for redundant provisions, we have Wazira's Revenue Authority officers, maybe who would want to stretch it and impose VAT on the example I have given, which would be very, very unfortunate.
That's an interesting one. Churchill, you must comment on this because you also sit in a place where FX could really impact the macros and everything else. What's your quick point on that?
Yeah, I agree with what Fred has said.
Yeah.
And also I'm looking at it in terms of, that aspect around what exactly will trigger the VAT to, is it on the transaction, is it on the point, or is there some fees? We don't know, there's some fees. But the ultimate thing that we'll see is there'll be that cost that will be loaded onto a consumer. So if you go to a bank, you want to get dollars, the exchange rate is 135. You might find that you're buying it slightly higher, 137 or some crazy rate, because now traders now want to load the tax on you. So that will be the unintended consequence that we might see. And obviously the thing that we've been hearing from a government perspective is that they want to attract foreign direct investment. So obviously that entails foreign exchange coming to Kenya. Does that mean also that they would want now to make it vatable, those transactions that are coming into Kenya, or even from exports? So I think it may not just be on a customer, on a retail perspective, but if we look at it from a from even a macroeconomic perspective, I think the ripple effects are quite significant and we need to rethink it through.
Okay. You know, I want to bring you in, Beatrice, and there has been conversations about tax refunds and, you know, tax disputes and all that. And I don't know whether this bill has a provision that will address these particular disputes and resolution mechanisms. Have you seen some of these areas?
Yes, and thank you for that question. So one of the proposals is to increase the period within which a dispute must be resolved at the IRO from the current 60 days to 90 days. One of the things that has used to happen in the past is the IRO would watch dates come and pass, and they would still continue passing and pressing the assessment, or they would give their decision outside the 60 times, but the 60 days. But the Tax Appeals Tribunal has been keen and on that, insisting that if you give an objection decision outside the 60 days, so then that would mean that your decision is invalid and you accepted the taxpayer's objection. So what is likely to happen now with that being increased from 60 to 90 days, so that will take a longer period, 90 days, that's significant.
True that.
So IRO disputes will take longer at IRO. Then there's also the introduction of that if you don't supply all the information, all the documents that are needed for your objection, then it is automatically rejected. Now, from experience dealing with the KRA, they can ask for information and ask on every other day. They're asking for information, so there is no clear line on what would be considered to be sufficient information. So from where I sit as a taxpayer, I can think I've given you everything you need, and then the person sitting at KRA will think there's something you have not given. Then that in itself could be a point of dispute. Okay,
fair enough. Let me bring you in, Kimotha, and from what you've spoken, you know, when I asked for the positives, you sounded like the employees would almost probably have an easier time. But as the conversation is ongoing, it looks like some other hidden things are coming back. And when you look at the overall cost of living then, if taxes will be introduced on transactions, if there will be some motor vehicle VAT coming by, it looks like at the end of it all, in fact, it's a bit more in a way. So there's really no reason to celebrate. I want you to correct me if I'm wrong and tell me, what do you see then in an overall perspective, especially the cost of living for Kenyans?
You're very right, MC. When you look at the bill in totality, we can only conclude that the cost of living is going to be higher. I mean, if you look at the ripple effect, and my companies have actually indeed mentioned this, and you could even pick something as simple as the motor vehicle tax. You'll actually notice that the ripple effect in terms of what impact they'll have on the insurance companies, because if, for example, today I'm paying, say, premiums, I'm paying a comprehensive insurance, I may consider not to pay comprehensive insurance and pay what we call a TPO or that party only. What does that mean to the income for the insurance companies? It would actually mean that the insurance companies are going to report less profits. What does that mean to the corporate income taxes? So there's quite a number of ripple effects that we are likely to see. So the only unfortunate thing is that we don't sit back as a country, for example, and look at the Finance Act of the previous year and ask ourselves, we introduced 1, 2, 3, 4. Have we done a study to see what is the overall impact? Because even now, as we speak, we can only make an assessment based on how we estimate, but you see, we also do not have the numbers. We can only estimate and say, given that they have introduced all these VATs and maybe they have also taken away ABCD, the cost of living is likely to be high. But overall, I do think that the cost of living is actually going to be high. Not to mention introduction of VAT on things like ordinary bread, introduction of VAT on locally assembled mobile phones. It was actually VAT was actually removed, I think, last year but one. So and other levies such as eco levy that are.
In fact, I wanted to bring that in because there was a statement, especially from the industry players, that said, listen, I mean, they easily compared to the cost of a battery and how the cost could actually double up. I don't know whether you have digested that through, because I thought we were trying to be as eco-friendly, but not as expensive.
And that's the thing, actually. And that's where we come back to a policy. What policy informs some of our changes as a country? Because if you look at the Finance Bill of 2024, equal levy is actually being introduced to, they say is to discourage or rather to encourage. It is actually targeting environmental
clean energy.
It's more or less like an environmental tax.
Yes.
But then in the same finance bill, you have introduction of VAT on electric bicycles, on electric buses. So there's a lot of contradiction of the policy in between.
Yeah.
And even this motor vehicle tax, when you listen to most of the people explaining the rationale, you almost left wondering, is this an environmental levy that is being imposed? Is it a wealth tax? Like, there is no that overarching policy that is informing the changes. So I agree with you. So things like eco-levy is also, and remember, eco-levy is also going to be applicable on what I would consider basic things like diapers, which is definitely going to, affect our moms.
Oh my.
In
Beatrice,
quite a big way.
Beatrice could help us on that a lot. But before we get there, Beatrice, one of the key defenses when I listen to the chairman speak is that, roads, for example, what we are collecting in terms of the levies and the fuel and all that are not enough to maintain them. And give examples when the floods happening, look at the highways and all that kind of thing. Another school of argument is that we should first of all put the infrastructure first before we come and say now there's levies being introduced on your vehicles and all that, so that now you can pay because you can see what's happening. Which should come first? I don't know, but this is in closing statements. What do you think?
I think when it comes to the motor vehicle tax, there is a lot of conversation about that. There is what the chairman of the committee said the other day, that they want to fix the roads. But when you look at it on fuel, there are already so many levies. There is the fuel levy, there is road maintenance, there is VAT on that. So all of this going towards vehicles, and then the cost really on the common Mwananchi is going to be very high. And as my colleague Fred has said, there is a lot of disconnection between what the government is saying it wants to do and what it's actually doing. Because if we were to come back to the issue of this motor vehicle tax in itself, so there will be increase in the insurance that someone will pay. Then when I go to repair my vehicle, I need new tires. There is eco levy on the tires, so the maintenance of the car itself goes up. Then the big question that then also comes now, when everyone gives their 2.5%, is this money really going to go towards the roads? That's the question that we now ask.
No, it's a big question. Where is the money going? Someone said that if we actually just, we're very keen on every expenditure of the money given and we're not losing through the taps of corruption and all that, we probably will be having a different conversation on this. Chachi, towards the closing now, and I want to ask you to begin on that. I want you to give us a perspective because you sit at a place where you see what other countries are doing. And I know in Africa we are a bit of a model, but I'm sure you sit in a place where you see a lot of policies outside there that probably could work. And the key thing is how we could have, prosperity in the economic side of things and have a financial system that really works. The examples that are given where people are taxed higher, but things are working and everything else. What do you think would be the solution? Sitting at a place where you're given this particular advice, what would be your closing on looking at this bill and saying, I think these are some of the things they should do, putting you on the spot on that?
Thanks. I think it was raised earlier on by my fellow panelists, the issue around putting even structures before even coming up with levies, for instance, the eco levy. But bringing it from the point of the affordable housing levy, there was a newspaper print today telling us to the effect that the monies that has been collected so far, it's around 36 billion, 20 billion for the affordable housing levy has been put in treasury bills. Because the board is there, but they don't even have the mandate to actually action on that. So it's really important to have structures in place before we can now be able to get the levies or implement some of these levies, which is quite important. I remember even during last year's discourse around affordable housing levy, those are some of the issues that came to light and we are seeing them at play. The other issue is pretty much even, let's remember that the whole issue around some of the tax proposals being brought in place is because of what you call the tax expenditure, or pretty much the revenue foregone.
Yeah.
There's some studies that yearly National Treasury puts out a tax expenditure report. As of 2022, the latest tax expenditure report, close to 394 billion shillings was not collected. This is revenue foregone.
Oh.
So they sort of pinpointed VAT, excess duty, and a whole income tax regime. The culprit there was VAT, which are the largest component of the tax foregone.
Yeah.
And that now speaks to the issues around what you're seeing in the financial and services sector, the banking and the insurance. This VAT being increased, but pretty much you can tie it to the tax expenditure reports. And also the issue around even alcoholic beverages.
Yeah.
Right now, they're not even, the tax is not on the quantity, on the liter of the bottle of beer or whatever, but it's now on the alcoholic content, which will make it a bit more expensive. So this is now tied to the perspective of tax expenditure report. It's good, yes, on paper, but I think there's a real rethink as to how to implement it rather than leading it on the taxpayers as it is right now. So I think that is quite important. I've seen other countries such as South Africa, just to your question, having minimal tax adjustments when they are issuing their budgets. Track it, I think they have specific tax amendment bills, 3 tax amendment bills in any given year, not as chaotic or as grandiose as what we're seeing in Kenya. I mean, 50, 65 clauses just to amend taxes. Even if you are having public participation, which other countries don't have, but I think it tends to be, it brings the issue about unpredictability in the Kenyan case, which is not seen in other parts of the continent.
Wow. We need to be predictable. Thanks so much, Churchill. Beatrice, I want to bring you in. What would be your final sentiments on this? And if you have any area you feel like we haven't touched, you could as well bring it in. But I also wanted to correct something. You know, when Kimodo mentioned about how mothers could be affected, especially when you touch on diapers, I just realized Churchill has a bill every single man on the diapers he buys. So the men as well bear the brunt. Don't worry. But please, Beatrice, what would be your last sentiments? Yes.
I think one of the things that is very important to look at is the effect that there are a lot of changes that have been introduced around excess duty affecting manufacturing companies. And one of the most significant is that the deletion of the section that allowed them to offset input excess duty. So that means I get to pay the output excess duty on all my accessible goods, but whatever I incurred when I bought accessible raw materials, I won't get that back. And then this comes at the same time. These are manufacturers are the ones that are using the packaging materials, which now have some aspects of excise, eco levy, there's VAT. So the cost of living on these consumables, examples are cooking oil and such things, sugar, when we see VAT on transportation of sugarcane from the farms to the factories. So these things compounded, they have a significant impact on the consumers, on the common mwananchi. And something else that is also very important to highlight is how complex our tax system is becoming. So one person is I'm paying motor vehicle tax on my commercial vehicles, I'm paying advance tax, I'm paying affordable housing, I'm paying shift. There's so many levies such that the tax is difficult in itself to understand. And one of the canons of taxation is simplicity. We don't have that in our tax system. It's very complex. That gives room to, that's why you see a lot of tax disputes that move on for years and years, because even experts amongst themselves, they cannot agree on what the provisions are. And then when we keep every year, we load up more complicated things on the same acts, becomes too much. If we were to really adopt the national tax policy, that would give certainty to investors. They know I'm coming in 5 years. This is what my taxes look like. This is what my expenditure looks like. By this year, I'll break even. But then you come here, you start a business, maybe a manufacturing farm, 2 months down the line, VAT goes up. The next month, excess duty more than doubles on a critical ingredient, something that you need. That throws off or your budget or your 10-year plan.
Okay.
It's quite unfortunate.
Quite something, right?
Yeah.
Fred, you have the last word.
Allow me to confirm that I'll also be passing by the supermarket. Buy a pack of diapers. Very good.
Go ahead. Yes.
You know, the finance committee and the on national planning.
Yeah.
That is the committee that is entrusted with this particular bill has invited the stakeholders to do submissions by 29th of May. That is, I think it is next week.
Yeah.
So we need to do those submissions.
We need to.
So what my parting shot would be that we try as much as possible. I know there has been conversations that maybe some of the comments that we put out there are not taken into account, but we should not tire.
Yeah.
I think we should play our critical role of shaping the tax policy of this particular country by giving our views in terms of what should happen, and in terms of the comments, I think we should also try to be also very critical on the bill. Yeah. There is always the risk of being carried away by some of the major provisions. Key among them, for example, is motor vehicle tax. Yeah. It would be unfortunate if all of us go to the committee and we are talking about motor vehicle tax. Yet there are some other submissions that are very detrimental to the economy. And I can give 2 examples. One of them is that the finance bill is proposing to overhaul what we call the digital services tax and replace that with what we call the significance economic presence tax. Now, if you look at the effective tax rate that the non-resident players in the digital market space are going to pay, it's actually going to be 6% of the revenue. If you look at the digital service tax that is being repealed now, it is 1.5% of the revenue. Wow. What does that mean? It actually means that we are almost, quadrupling, if there is such a word, the rate that is actually applicable. It could be we have to change from the DST to this significant economic presence, but we also need to check what is the overall impact on it. And another one that I think also is very critical from a dispute resolution mechanism perspective, which is also a very silent provision that is under the finance bill. There's a proposal to delete circumstances under which, one of the circumstances under which the commissioner can issue what we call an agency notice. That is specifically what they're proposing to delete is where you have gotten a decision that is adverse at the tax appeals tribunal, a decision that is not favoring you. It is favoring the commissioner. The commissioner is now, if this is passed, the commissioner is going to be empowered to issue an agency notice even before you exercise your right to appeal at the High Court. Right. That is big, because what it means is that whenever you get a decision from the TAT, you have to learn to the High Court, first of all, to get a conservatory order to prevent an agency notice being issued by the Revenue Authority. And you can imagine sometimes the action of the agency notice could be quite fast. So by the time you're going to the High Court, money has already left your account. Yeah. So I think those are some of the provisions that we probably need to think about very deeply and ensure that we give our comments, and hopefully, and I believe the committee will actually do consider our comments, like we have seen the chairman commit to the public that will consider all the comments that we put out there.
Wow. Gentlemen and lady, thank you so much for your time. That is Chachilo Gutu, economist at IC Group, Beatrice Ndungu, tax manager KPMG, and Fred Kimodo, senior tax, Deloitte East Africa. There you have it. 28th of May is the deadline, so please make sure you give your submissions. They are willing to listen. And as you heard it, it's up to you. Don't just keep quiet and wait for the others to do so. If you have something to say it now. There you have it. I leave you now with the markets. Have a good one.